Hi everybody, I'm Mike Swanson. Greetings from Nashville, Tennessee. Glad you could join us today. We're going to be talking about the 9 hidden costs of self-funding your case expenses for contingent fee law firms. So let's get started. And today's webinar is brought to you by Advocate Capital. And Advocate Capital is a purveyor of the AvoTrack case expense funding service. Full disclaimer, this is me. I'm the CEO of Advocate. I also wrote the only book for finance to help plaintiff lawyers ever published. It's called How David Beats Goliath. If you'd like a copy, message me later. I'll be happy to send one out to you. So disclaimer, like I said, we provide an alternate to self-funding case expenses, but we're not going to talk about that today. We're going to talk about a way to think differently about case expenses. And this webinar is for both clients and prospective clients who might be using some or all of their own cash to fund their own cases. So first, a disclaimer, got to get the legal stuff out of the way. This is a webinar for informational purposes only. I am not a CPA, I'm not a lawyer, so if you're going to take some action based upon the webinar content today, be sure you're getting professional advice from your accounting and legal professionals. But do feel free to share this with them or your investment advisor and get their take on things. So, all right, we'll keep moving. So I'm going to challenge you to think differently today about your case expense dollars, and we're going to think about that both from a hidden cost and apparent cost standpoint. The apparent costs are easy, right? So that's a bill you write, a check you write for something. That's easy to think about. But there are also hidden costs that you may not realize are there, or you may not have fully considered. But first, we're going to do a poll. So we want this to be interactive, so we'll kick our first poll today. And the poll is, where should case expenses appear on a law firm's financial statements? So on your screen now, you see the poll. Should it appear on the income statement, on the balance sheet, all of the above, or none of the above? So go ahead and vote. We'll give you a few seconds to do that. It's anonymous, so I won't know which way you voted, and we'll give you just another moment or two. Just pick one. There's no penalty if you get it wrong. One. Okay. Okay, somebody else is voting. Okay, great. So I'm going to close it out now. Most of you said on the income statement, which I'm sorry to say is not accurate. Case expenses should appear on the balance sheet of the law firm. And that's something that's mandated, if you will, or directed by the Internal Revenue Service. They've opined on this many times before in the past. And they actually opine on the tax implications, not necessarily where it appears in your financial statements, but they have given guidance to their auditors that case expenses, because they come back to the law firm so frequently, 95% of the time, case expenses are not an expense that should be deducted in the current year against income, but rather they should be booked or counted as an asset or a loan that you've made to your clients. So if you are seeing your case expenses appear on your income statement, it'd be great to ask your CPA about that, because you also might be treating them incorrectly for tax purposes. Last month, or 2 months ago, we had a webinar on that topic specifically. So if you go to advocatecapital.com videos, click the webinars link, you'll see one on there, proper accounting for tax purposes for case expenses, where we had legal expert Robert Wood join us from San Francisco. I think it's pretty informative, one of the best webinars we've done on that topic. All right, let's move on. So the money that you have tied up in case expenses, where did it come from? Well, I think it came from legal fees. But let's think about it for a moment. How much did you have to actually bring in to net out, let's say, $500,000 in case expenses? Let's walk through that with some quick statistics. I'm going to share this so you can see a little bit better on this particular view. So share wrong screen, so I'm going to stop sharing that. So hopefully you can see over my shoulder here the slides going up. I'll take you through it. So if you have $500,000 tied up in case expenses, that would have implied that you paid taxes. If you're in the 35% bracket because of pass-through, you would have paid about $269,000 in taxes. You add those together, that meant you had pre-tax profits of about $769,000. Backing out further, if you factor in what we find is a typical overhead rate for law firms of 55%, you would have also paid $940,000 in overhead. that means that your gross legal fees to bring all that money in would have been $1.7 million. And then when you think about the portion that the client got, if it's a 1/3, 2/3 split, the client would have gotten 3.4 million of that. When you add that all together, you're north of $5 million. So, wow, that's a lot, isn't it? It's a pretty good rule of thumb. Even if you're smaller and you have $100,000 out in case expenses, you probably had to have verdicts or settlements around $1 million to be able to come up with that much after-tax cash. And you may not even gross $1 million a year in revenue, so it might be 1 or 2 years worth of settlements and verdicts just to get there. Great. Okay, we're going to do another poll in just a moment because market value applies to all assets, including your case expenses. So let's do the next poll. And it's going to be, what is the market value of an asset? So you should see that pop up on your screen now. Is it the amount recently paid for the asset plus inflation? Is it the amount a willing buyer would pay to a willing seller? Is it the value as determined by a licensed appraiser, or what a seller would be willing to sell it for? So take a stab at that. Click on one of the buttons to vote. We'll give you another minute or two. So it's the amount recently paid, what a buyer would pay, what an appraiser says it's worth, or what a seller would be willing to sell it for. Don't worry if you missed the first one. Just take a shot at this one. We'll close out in just a moment. Okay. And most of you said, A, the amount recently paid for it, but I have bad news. It's actually the amount that a willing buyer would pay for it in the marketplace. And this comes up fairly frequently because what is your law firm worth? And you may think it's worth a lot. It's worth a lot to you, obviously. Someone would have to pay you a lot to let go of it, right? But what is a willing buyer willing to pay for the law firm? And what would they be willing to pay to step into your shoes for just your case expenses? A greatly reduced number, I'm sure you'd agree. All right, let's just start with the 9 hidden costs. And the first is a reduction of liquidity. And all these hidden costs are essentially impairments of your net worth as a law firm owner based on several factors that we'll go over. So it's not cash out of pocket that you notice on your income statement, but it's a definite undermining of your personal net worth and increased risk of your personal net worth. And the first is liquidity. Liquidity refers to how quickly an asset can be converted to cash. So the ultimately liquid asset would be cash itself. You can't get more liquid than that. So if we think about a house, it's not quite as liquid as cash, because if you wanted to turn it into cash, you'd have to list it with an agent, have a showing, get to a closing. So it could be 90 to 180 days before you could convert that asset to cash. So you can also think about then, if you had, as an example, a house that was worth $500,000 or $500,000 of cash, which would you rather have? Most people would take the cash, right? And part of the reason they would do that is because cash is liquid, and they would have to liquidate the house if they didn't want to live in it. Next is lack of utility. So lack of utility of an asset refers to your ability to use it for something. And in this example, if you had two houses, House A and House B, and they're both worth $500,000, and House A, you can do anything you want with it. You can live in it, you can rent it, you can sell it, you can leverage it, whatever you want to do. But House B, you can only own it. You're not allowed to live in it or do anything else with it. I think it's pretty obvious that House A is a better value, and you choose that one. And again, one of the reasons is you can use it. You can do something with it. Well, when you let your cash remain in your law firm to be used for case expenses, you've lost the utility of that cash. You can't do anything with that asset any longer. It's tied up indefinitely. So lack of utility is when you've just given up your cash and let your law firm hang on to it. Next is lack of potential income. So if you had that $500,000 of cash, you could use it to earn some kind of income, right? Maybe you would buy a house and rent it. That certainly is a plausible use for that cash. So you could find different ways to generate an income stream with your $500,000 of cash if it was outside the law firm and available for your personal use. Of course, when you allow it to be tied up by the law firm, you're guaranteed zero income on that cash. You're never going to have a chance to make any money using that money. So it's a lack of potential income. Next is a lack of appreciation. So appreciation is when an asset increases in value over time. And if we think about assets, what are the best types of assets to own? Well, as business people, we want to own assets that are either useful and or can produce income and or will appreciate over time. Well, your cash tied up in case expenses has a 0% chance of appreciation. We've already said it's not useful, it can't produce income, and it has a 0% chance of appreciation. You put your $500,000 in your case expenses, 30 years later, it's still $500,000. There's no appreciation whatsoever. So if I was your financial advisor and I said, hey, I want you to buy this stock in the stock market, guaranteed over the next 30 years, it will never go up in price. You'll make no money off of appreciation. You'd fire me, I'm sure. That'd be a bad investment. Next, increased risk. This is pretty counterintuitive, and I know this because we speak to lawyers on a regular basis, and some of them will say, well, I don't want to use case expense funding or leverage my case expenses because they think that my cash is, that they think it's risky, right? I'm debt adverse, and it's very risky to take a loan against my case expenses and pass the interest through. Well, I disagree. I think that putting your cash in your law firm in harm's way, essentially, is one of the riskiest places you could put it. Your law firm, bad things happen to good people. We all know that from being in this industry. What if you got disabled for a period of time? What if one of your employees embezzled from you? What if a new competitor came in the market and suddenly you have a downturn in revenues? Well, when that cash, when those case expenses start coming in, you're probably going to use the reimbursed case expenses to help fund the operation. So it's a very risky place to leave your cash. You can think about the effect of risk on the value of an asset by thinking about two mortgages. If two mortgages had the same face nominal value of $500,000, but the first mortgage A had a credit score of 730 and a 20% down payment versus mortgage B with a 630 score and a 5% down payment, the two pieces of paper say the same dollar amount, $500,000, but I can tell you in the marketplace, the riskier paper is going to be able to demand a much lower value from the marketplace. So I think the best place for your cash is in your personal bank account outside the law firm, insured by the FDIC. I think it's the best way to go. But if you're self-funding, you've allowed that cash to be converted to a case expense receivable. All right, number 6, taking a subordinate position. So if you're familiar with Uniform Commercial Code, lending, filing security agreements and things like that, you'll understand the position of liens, right? And if you look at a balance sheet of a law firm, you'll notice in the liability and equity section that the liabilities that are owed to other people are listed there, and equity comes after that. So when you allow your cash to be tied up in your law firm with no note back to you, no coupon payment, no security interest, you've essentially taken what is basically an equity position, and you're subordinate to any other debtors that the law firm might have. That would include any lines of credit you would have, any accounts receivable, any payroll that's due. So even your employee's payroll would take priority to you in a liquidation if that happens. So you have taken a subordinate position, and you're behind a lot of different people. If there is a bad turn of events at your law firm, you're behind everybody. You converted it to equity, is what you've done there effectively on the balance sheet. And you get the money last. Great. Next, inability to leverage. So one of the nice things about certain assets is that you can leverage them. And so if you own, in our previous examples, a house free and clear and it's worth $500,000, you would be able to go out and get a loan against that house, right? Most likely. Maybe you could borrow $400,000 against the house. You could rent that house out and buy another one for $400,000 and rent that one out. So using leverage in an investment strategy can be effective. Now, I'm not telling you to do that. It's not my advice. It's an example of how the ability to leverage an asset makes it more valuable, makes that asset be able to generate potentially more income and appreciation, because in that example, you'd be getting rent from 2 houses and you'd be getting the appreciation on both of those houses over time. So unfortunately, no lender is going to allow you to leverage just your case expenses, right? They may just put a lien on your accounts receivable, but most likely they're going to want to put a lien on all assets at the law firm, maybe even some of your personal assets. So the inability to leverage, as I mentioned, here's that example, house A or house B, which would you rather have? A, of course, you can borrow against, B, you can't. So the difference in some of that is because of the ability to leverage that. All right, number 8 is the effect of inflation. So we're going to do our third and final poll now. I'll kick that off. And the poll is, how much did a loaf of bread cost in 1970? I'm willing to bet that a lot of the people viewing this were not alive then. I was 8. So you might just have to guess on this one. But what do you think a loaf of bread cost in 1970? I'll allow a few of you to vote here. Oh, you're getting this one right so far. Good job. All right. Great. And we are going to close that out. And everybody who voted got that one right. The answer is 25 cents. So inflation affects the purchasing power of a given dollar, right? So going back to the poll we just talked about, in 1970, a dollar could buy 4 loaves of bread. In 2019, you can't even buy a whole loaf of bread with that. So if we transfer that concept to your case expenses, let's imagine that your case expenses, instead of having them tied up in your cases, you bought a house with it in current dollars. Well, if you waited 30 years to retire and then got your $500,000 out in 30 years, what's that house going to look like? It's going to be a lot smaller house because you would have had 30 years or so of the effects of inflation, so it undermines the purchasing power of your dollar. All right. Lastly, and this is a little bit of a summary kind of some of the things we've been talking about, are opportunity costs. So think about what you could do with the cash you have tied up in your cases if it wasn't tied up. If you could get it out and get into your personal estate, you could do investments, maybe grow your practice, help even more people, and I think it's a lot less risky as well to get your cash out of your cases. So, great. Okay, looks like we might have it. Is there a chat there? Somebody? No, I guess I'm mistaken. I don't do that many webinars. So we're going to open now to questions or comments that you might have. So let me give you a chance to you can type those into the chat of the panel or the website. I'm sorry, for the webinar chat. So open it to questions. Good old Starbucks. Can you get a copy of the private letter ruling? Absolutely. So private letter ruling 8246013 from the IRS, we'll be happy to send that to you. It was issued in 1982. If you go to advocatecapital.com, you can inquire there or send me an email, mswanson@advocatecapital.com. We'd be happy to send you a copy of that. There is that other webinar. If you go to Advocate Capital Videos Webinars, we have an entire webinar just on that topic that you might want to share with your accounting and tax professionals that might be helpful as well. How does Advocate Capital work? Okay, well, we're not going to do a full commercial. Advocate Capital provides a line of credit for law firms for funding their case expenses, and then our technology called AdvoTrack tracks it case by case. And we do that because with that technology in place, our clients can pass through the borrowing costs of those case expenses through the cases. So the net cost of borrowing for our clients is 0 for the cases that they win. So that's probably enough on that. More information, of course, at advocatecapital.com. What are your rates? Okay, I'm not going to get into interest rates here, but again, through our website, advocatecapital.com, find your rep, click on your state. We will be glad to send you our standard terms, which lays out all of our pricing, but also all the detailed terms of what is the collateral and things like that. So we're happy to help you through there. Okay. Okay, I think we'll wrap up with that. So thanks so much for joining us. If you would like to contact me, call our toll-free number, which is on the screen now. And I'm going to say that's a wrap. So have a great day.